TSMC recently released their Q4 2020 quarterly financial report. The results were quite good. TSMC has become one of the world's most profitable companies. In 2020, the company generated net income of something in the neighborhood of $17.5 billion, depending on the USD and Taiwan dollar exchange rate. The company generated more 2020 profit than Walmart or Tencent, and roughly as much as Facebook. Its products make 53% gross margin, which matches Intel's reported 53% gross margin in Q3 2020. Though Intel has a lot of moving parts, and that probably brings things down a bit from the core. But the big surprise was not the profit, but TSMC's company guidance for Q1 2021 capital expenditure. Capital expenditure represents expenses spent on expanding overall capacity and upgrading manufacturing technologies. This number is a long-term leading indicator of where TSMC believes the market is going to be. And we're going to talk about that. But first, yes, I have a Patreon now. Ad income is always volatile, but coffee costs the same every day. I do want to call out a nice perk. I make videos pretty far ahead of the schedule, but they are also queued up in YouTube waiting to be released. The early access tier, which is $6, lets you watch all those videos right now ahead of time. The number of videos will fluctuate, but right now it's at 8, and I hope to keep it at 5 to 6. You'll be able to get to see new videos as I make them as well. So head on over to the Patreon page and take a look. I deeply appreciate anything you'll be able to sign up for. Thanks, and on with the show. In 2020, TSMC spent $17.2 billion in capital expenditures. This is $1 billion over the $15 to $16 billion range that they had projected back in 2019. They had raised it midway through the year. The $17 billion was a record for the company. Analysts had expected the company to announce $20 billion of capital expenditure for 2021. It would roll over the $17 billion from 2020 and add the capital for the Arizona plant. TSMC had earlier announced in November 2020 that they were going to build a small N5 fab in Arizona. The board allocated some $3.5 billion in spend for this. While this $20 billion in retrospect seemed to be far too little, for 2021, the company announced that they would spend something in the range of $25 to $28 billion. A lot of words has been spilled on the internet trying to figure out why the jump in capital expenditure. Right now, I'm just trying to grapple with the sheer size of the number. $25 billion, the lower end of that number, would represent as much revenue as Mondelez, the Oreos maker, and number 117 on the Fortune 500. It would be more than Tesla's 2019 fiscal year revenues, which is $24.5 billion. $28 billion, the higher number, would be the size of a Starbucks, $26.5 billion in revenue, or a Viacom CBS, $27.8 billion. In terms of sheer numbers, TSMC's CapEx budget rivals capital expenditures from tech giants and telecoms. That includes Verizon at $17.9 billion and Google at $25 billion. Anytime you're building big data centers and installing new networks, you're spending billions of dollars on building up things and assets. Oil and energy companies like Exxon, $25 billion, and Royal Dutch Shell, $20 to $29 billion, are also peers. Amazon has a demonstrably higher budget with $32 billion, but Amazon is also scaling up immensely as it tries to dominate the e-commerce and cloud spaces. For me, I think you don't spend $25 to $28 billion, which is a huge jump, just for one reason alone. There must be a multitude, and I'm going to go through them today. The first has to do with the demand from the unprecedented economic environment. The first wave of the pandemic led to everyone shutting down and the economy crashing hard, but then it came back roaring faster than people thought was possible. At the same time, the work-from-home economy came back harder than ever after the summer ended and the pandemic surged. You need chips to fuel all those cloud software services connecting today's companies. Another source of demand came from your car. On the earnings call, TSMC mentioned the automotive industry, where revenue surged 27% from the previous year. Your car uses a surprisingly high number of chips to help it operate. The Wall Street Journal recently ran an article noticing that a chip shortage in the automotive industry has caused some factories to wait for supply to replenish. Automotive, financial stimulus, a new generation of video game consoles, lockdowns from the pandemic's second surge. In addition, we have chip demand stemming from the new crypto surge and the ongoing 5G transition. It's all insanity and craziness. The second big reason to really push hard has to do with competition. TSMC is dealing with a challenger unlike few others that has gone up against. Samsung Foundry, part of Samsung Electronics, is making a real push into the market, capturing reliable business as a second supplier. The Korean giant is estimated to spend some $26 billion in capital expenditure for its semiconductor business in 2020. There is the caveat that Samsung is also the world's dominant memory maker, and it is assumed that a vast majority of that capital is going into reinforcing that business. Not all of that can be leveraged for making logic chips. But it's a lot of money regardless, and it needs a response from TSMC. But Samsung is really swinging for the fences. For its cutting-edge 5nm process, the company has collected customers like Ambarella, the image sensor maker and supplier to Hikvision, and Qualcomm. They have a big Austin semiconductor foundry and are considering a $10 billion Texas investment, similar to Taiwan's Arizona facility, so to win more American clients. And then there is the anticipation that Samsung is seeking to implement a brand new semiconductor structure for its next generation 3nm node, something called Gate-All-Around. TSMC's version of N3 will not be using this structure, and for this reason Samsung has been cited as seizing the technology crown upon the release of that 3nm process. Well, since we already touched on the topic, let us talk about N3 and beyond. TSMC's sexiest, most cutting-edge process is N5, the one that Apple calls in its marketing 5nm. This process entered high-volume manufacturing in Q2 2020 at Fab 18 in Tainan. Through 2020, it was majority booked by Apple for its A14 and M1 chips. I talked about this in another video, but to match Apple's annual iPhone cadence, TSMC has a half-step strategy. They debut a new variant of their node every year. For example, N5 for the A14 this year. Next year, they will make refinements and release a Plus version. A15 will be made on that N5 Plus. And the year after that, N5 Plus then evolves into an N4 process, which means further refinements while maintaining backwards compatibility. Apple moves on to the next major step, an entirely new node, N3. This follows what TSMC did with N7, which evolved into N7 Plus, and then N6 after that. It allows customers to deliver improved product year over year without much additional work. As mentioned, the next big jump from N5 is N3, colloquially called 3nm. And like I mentioned earlier, it will stay with the same FinFET device architecture that helped TSMC deliver the last few generations. I've seen some rumors floating around that N3 was going to be delayed. There was a DigiTimes report that said that N3 was being particularly challenging for both TSMC and Samsung. And that leaves some risk that the Apple A16 might not be fabbed on N3. If that's the case, the backup plan would probably be to use the evolved N4 node. But during the conference call, management said that N3 is on track. The DigiTimes report might be wrong. It probably can be, considering their track record. But it can also be that TSMC is trying to make up for the lost time with a dump truck of money. TSMC hasn't missed a deadline for a node delivery in many years, so they are pushing super hard to hit that 2022 high-volume deadline for the iPhone launch. As for what happens after N3, the future is hazy. At the TSMC Technology Symposium in September 2020, the company gave a brief look at the future roadmap beyond N3. N2 appears to be the next big node. The company appears to be in the early stages of a massive N2 fab push in Hsinchu, and that is going to cost a lot of money, but that's still far ahead in the future. The Intel thing. A lot of financial analysts were watching this, and I was holding this video until the reports came out. Intel CEO Bob Swan had said that the company would look at the possibility of outsourcing its high-end logic chips to a third-party foundry like TSMC or Samsung. Such a decision was said to be announced at the Q4 earnings call in January 2021. There were a lot of smoke signals coming up that Intel would be indeed signing on to such an outsourcing agreement. The stock market ran up TSMC's stock price in anticipation of it happening, and Bloomberg ran an article saying that TSMC and Intel had been in talks, with no result yet. Then Bob Swan stepped down, and new CEO Pat Gelsinger took up the seat. Intel's first CTO, Gelsinger, has an engineering background, and in the Q4 call emphasized Intel's commitment to its engineering and manufacturing. He says, I am confident that the majority of our 2023 products will be manufactured internally. At the same time, given the breadth of our portfolio, it's likely that we will expand our use of external foundries for certain technologies and products. The stock fell 9%, an interesting response by the market. There's a real argument for semiconductor foundry work to be done on American soil. One can say that the market is ignoring those national security arguments and being short-term. But one can also care for those arguments and just instead be saying that they don't think Intel should be the company leading that charge. Putting those questions aside, the Intel and TSMC relationship is going to put itself on hold for a little bit as management reviews the status of their 7nm process, which is roughly equivalent to TSMC's N5. Tin Kolpen for Bloomberg wrote an analysis of the results that I liked. In it, he cites one reason why TSMC would move so aggressively with the capital expenditure, and that would be to corner the market and lock in supplier agreements. Tactics like this would be taking a page out of Apple's supply chain handbook. Apple leverages its cash reserves and size to secure supply for its products ahead of practically everyone else. That is why you were able to buy the new iPhones this holiday season with decent wait times, while other consumer electronics companies like Sony struggle to fulfill demand. And Apple sells something like 75 million units a quarter during the holidays. I've touched on TSMC's business tactics in prior videos I've done on Chartered and SMIC. My feeling coming out of that is that they will not hesitate to throw their weight around. Like Apple, they're going to try to muscle their way to the front of the line so to get whatever supplies they need to fulfill demand. And based on supplier ASML's recent quarterly earnings call, TSMC's supply chain right now seems to be in a bit of a dizzy spin. ASML, TSMC's critical EUV supplier, is only capable of delivering a limited number of said EUV machines in a single year, and its big customers' projections had moved around a lot throughout 2020, causing a backup in the supply chain. ASML CEO and President Peter Wennink said in the call, "I think our capacity in the Netherlands, in Veldhoven, is to build 50 systems. Now we have to build those systems out of modules, which we don't produce. It's in the supply chain." He then talks about the two customers moving their spend around. What happened last year in Q2 and Q3, our key foundry customer came back and said, "Listen, our key customer for N3 is now blacklisted, so we cannot ship. So we need to adjust our 2021 outlook for EUV systems." Peter is probably referring to TSMC and Huawei HiSilicon. Huawei has long been a leading-edge customer alongside Apple. They got banned from using EUV tech by the Trump administration. Peter continues, which was followed by another customer and said, "Well, we're going to delay the roadmap," pushed it back 1 year, which actually led to a situation where we actually reduced the number of planned system 2021 for EUV. This customer is probably Intel, and it matches up with how Intel in July 2020 announced that their 7nm process, which uses EUV, got delayed 6 months. But at some point between Q2 2020 and Q4 2020, TSMC and the rest of the foundry industry realizes that they are way under capacity. Like I said earlier, astounding demand in everything that has to do with semiconductor chips. So TSMC, and I presume other foundries in the industry, go back to ASML to put those orders back on the menu. The ASML can't just ramp up on demand because just 7 or 8 months earlier, they told their entire supply chain to ramp down. Peter did hint that Intel's delay let them transfer Intel's EUV orders over to TSMC and Samsung. Despite that, my guess is that for the next few quarters, per the CEO, there's about 20 months between module production and EUV tool installation. EUV machine supply is going to be super tight. Project this out to the rest of the foundry supply chain. It's not just ASML, and you get the feeling of a massive oil tanker trying to turn on a dime. You can get things done right, done fast, or done cheap. Pick 2 out of the 3. TSMC is apparently picking done right and done fast. Damn the cost, they're going to buy everything. For what it's worth, Wennink warns us about the folly of using those TSMC capital expenditures to project ASML's 2021 revenue. This is due to the supply issues mentioned above. He says, yes, TSMC gave a range, $25 billion to $28 billion. Hey, great. We plan our business based on what they ask us. And as you know, TSMC has been asking us in 2020 on several occasions to ship very different numbers for 2021. So I don't think you can draw any direct conclusion from the TSMC CapEx numbers. Directionally, yes, but not in absolute terms. Whew, crazy. I'm reminded of a story published back in April 2001 when Morris Dang still ran the company as its founder and CEO. In it, TSMC was a few generations behind Intel, but doing their best to catch up. 2001 was a year after the tech bubble crash, and the electronic space in general was suffering. But regardless, TSMC pushed ahead with its investments. This means not only building more foundries, but also investing in being able to better provide service to their customers. Zhang saw an opportunity and poured in the money to service it. I get the sense that TSMC is a company that likes to take big swings at things. Unlike Chartered and SMIC, they have the power of the purse, and they leverage it like few other companies can. A famous investor once said that their entire job is to stand at the batter's box and wait for a fat pitch that they can swing at as hard as they can. Hit one big home run, and it does not matter that you missed a bunch of little things. And I think TSMC thinks a big fat pitch is coming up. All right, everyone, take care of yourselves out there. Like and subscribe the Asianometry video channel if you want, and take care of yourselves. Stay safe.